Today I will teach you how you can analyze the balance sheet as a dividend investor and how you can check how much a company is worth on paper in a matter of seconds. The balance sheet is, together with the income statement and the cash flow statement, one of the three important documents which you should learn to analyze to be a successful dividend investor. So let's get started. Hi everyone, today we're going over the balance sheet, next to the income statement, a very important document. Last video I went over the income statement line by line. In today's video we'll follow the same format by going over the most important aspects of the balance sheet for us dividend investors. At the end of that part I will explain how you can see what a company is worth on paper in just a few seconds. It's very important information to determine the intrinsic value of a company. Don't forget to watch until the end, because in the last part of this video I'll review my portfolio, see how it is faring in these market circumstances and why I'm not worried. When I had a course in basic bookkeeping as part of my current job at a bookkeeping software company, the teacher explained the difference between an income statement and a balance sheet like this. Income statement is like a movie where there's constant movement and action. The balance sheet is like a picture or a snapshot that shows the assets and liabilities at a certain point in time. The assets are things they own, whereas the liabilities are the things they owe. Fun fact of the balance sheet, as the name already implies, is always in balance. The total assets of a company are always the same as the total liabilities plus stockholders' equity. The balance sheet can help us investors to determine what the business is really worth. If we deduct the total liabilities from the total assets, we know what the equity of a business is. Meaning what the business would be worth if the company was liquidated, meaning they sold all their belongings, assets, and paid off all what they owe. The easiest way to understand this is to look at your own finances. Let's say you have a house worth 200k, a car worth 2k, cash worth 3k, investments worth 7k. On the liability side you have a mortgage for that house, 120k. You have a car loan of 1k and you have a student loan of 1k. So the total assets are 212k and the total liabilities are 122k. And the difference between those two is the net worth. So if you add the net worth, then the liabilities including net worth are also at 212k. It's also how it works for companies. The difference between total assets and total liabilities is what the company is worth on paper. This is a very important concept to understand, because the closer the equity is to the market price, the safer the investment is. This is also referred to as the margin of safety, which is coined by Benjamin Graham from The Intelligent Investor. So here we have the balance sheet of 3M. Like I said, the balance sheet is divided into assets and liabilities. The difference between those two is the stockholder equity. First part is the assets. The assets can be divided into two parts, the current assets and the non-current assets. We'll go over the current assets first. Again, don't feel overwhelmed by all the data. I will take you through it bit by bit. So starting with the total current assets, above that we have cash and cash equivalents and short-term investments. So cash and cash equivalents is basically cash in the bank, and cash equivalent things that are highly liquid and can be converted to cash quickly. So stuff like market accounts, US Treasury bills, commercial paper. Depends on the type of business how much cash is needed, but what you don't like to see is a sharp decrease in this area. So if you take a look at the trend of the cash and cash equivalents, and actually this also includes short-term investments, the picture is not that bright. If we take a look at 2010, it was 14.8 billion. And in 2019 it was 5.5 billion almost. And year over year there was a decrease of 38%, so that's quite significant. So there's definitely something to look into further, into the annual and quarterly reports, to see what's going on there. The next line of interest is the receivables. So when a company sells products, their customers usually don't pay directly, especially when they're selling to other companies. So the money that the company still has to receive from their customers are listed under the receivables. If there's a fluctuation in this area, it can tell us a few things. The receivables are constantly increasing. It could mean the company is not managing outstanding balances on their customers very well. Well-designed administration process means sending customers reminders after the due date. The outstanding invoice has passed. If needed, several reminders, or even sending it off to a debt collection company. And of course it can also fluctuate with the amount of sales they've done. If they have done less sales, then obviously the result of that is that the account receivables will be less as well. Again, looking at the trend line of 3M, we can spot that year over year there was a 21% decrease, and from 2010 to 2019 was a 10% decrease. Next up under the total current assets are the inventories. So the inventories are basically all the products that are ready to be sold but are lying in the warehouse of the company, of 3M in this case. There should be a balance between how much inventory a company has, too much, and there's a risk that part of that inventory is never sold or at decreased prices. For example, if Apple has too much inventory of a particular iPhone model that it can't get rid of, then that will cost them money in the end. On the other end, not enough inventory means you can't serve your customers, which obviously is bad for business. One of the warning signs for us dividend investors is if the revenue is going down, but the inventory spikes up. This means they can't sell their inventory. A recent example of that is the Boeing company, where revenue went down and inventory spiked up. The inventory should be relatively stable. Sum it all up, the total current assets of 3M have decreased over the years. It was 14.2 billion in 2017 and in 2019 it's 12.9 billion. Then we move over to the current assets, starting with the property, plant and equipment. I think that speaks pretty much for itself. What we can see there is that 2019-2018, the total assets for that part, for the property, plant and equipment, has increased. And what's interesting here is that we see the top line right here, and then under that we see a line called cumulated depreciation. This means that the asset is being written off. So when you purchase an asset, it naturally becomes worth less over time because it's being used and it gets old. So in order to reflect that in a balance sheet, an asset is depreciated, and that's actually just a method to show an estimate of the current value of the assets. Next up are the equity and other investments. So those are actually the long-term investments. It could be bonds, equities in other companies, etc, etc. Then we have goodwill, and goodwill is actually also an intangible asset but differs in a couple of ways, which I'll talk about in a bit. So the value of goodwill typically comes from acquiring other companies that are acquired above the book value of that company. The difference between goodwill and other intangible assets is that goodwill has an indefinite life and cannot be sold independently. Then the next line item is intangible assets. Those are assets such as patents, copyrights, trademarks, etc. What is important to know is that only intangible assets that are allowed to show up on the balance sheet are intangible assets that are acquired with an identifiable value and useful lifespan. Intangible assets are valued according to their purchase price and amortization schedule. If we then look at the total non-current asset column, we see that the total non-current assets are up significantly year over year from 2008 to 2019, and the total assets are also significantly from 36 billion to 44.6 billion. And so where is that coming from? We can see quickly that the goodwill has increased and that also the intangible assets has increased significantly. So apparently they've acquired some more trademarks and copyrights. So what does this all mean for a dividend investor? Because we are in the end dividend investors, so that's what we care about. You have to understand what every asset means because it directly impacts the value of a business. More on how to assess that later. Next part of the balance sheet are the liabilities, so the things they owe. So we start again with the total current liabilities, and under the current liabilities we have short-term debt. So those are basically things that are expected to be paid back in a year, stuff like short-term bank loans, etc. And we see there, you can see that the short-term debt has actually more than doubled from 2018 to 2019. Again, something to look into further. The list is getting long. And we have accounts payable. So that's the money we have to pay back to our suppliers for goods that were delivered to us. And that's around the same ballpark compared year over year. So from 2018 to 2019. Then we also have the taxes payable. What's funny with that is that the revenue is higher, then naturally you would pay more tax. So actually, the more tax you have to pay, the better you probably have done, because you pay a percentage of your revenue. Total current liabilities has also gone up from 2018 to 2019 by just under 2 billion. Then we move over to the non-current liabilities. The most important item under the non-current liabilities is the long-term debt. Long-term debt is all debt that is not due within a year, such as long-term bank loans, bonds, etc. Obviously, the lower the debt, the better. Again, I would like to look at the year-over-year trend, and also the long-term trend. A way to look at how much debt a company has is by two ratios. That's the debt to equity ratio and the debt to capitalization ratio. Debt to equity ratio is the term debt divided by the shareholders' equity. The debt to capitalization ratio is the debt divided by the debt plus shareholders' equity. And by debt we mean both short and long-term debt in this ratio. Good ratio for debt to equity is around 0.5. That depends on the industry. So a way to check how leveraged the company is to check the peers in the industry, see how it holds up. Same applies to debt to capitalization. Good debt to capitalization ratio is above 1.0, which indicates that the capital in the company is higher than the total debt. If we take a look at 3M, we can see that in 2010 it was at a nice 0.27, and in 2019 it was at 1.81, so it increased by a lot. Again, something to take note of. Same applies to the debt to capitalization. It was at 21% before, and now it's at 63%. We can also see the increase on the graph. With the debt to equity, see 2010 it was quite low, and here it's more than 8 times as much as in 2010. Then, exciting part in the video, total stockholders equity, which we can see at the bottom here. And the total stockholders equity is simply the total assets minus the total liabilities, and that is what the company is worth. So in one glance you can see here what 3M is worth on paper. It's also known as the net worth or the book value, is on a per share basis. This can be compared to the current market price to determine if a company is trading above or below its book value. Usually it's trading above, since future cash flows are also into the market price. However, if we take a dividend payer from the energy sector, ExxonMobil, it is actually trading below its book value at the moment. If we go to the key ratios of ExxonMobil, we can see in 2019 book value per share is right now at 44.85. If we then go over to Seeking Alpha, we can see that at the moment ExxonMobil is trading at 34.49, so that is quite a discount to the book value per share. Now, this is not to say that ExxonMobil becomes an instant buy. You would have to look deeper into the company for that, but this is a good example of company trading below its book value. So one thing to keep in mind for us dividend investors though is that the shareholders equity will be lower than it would be if it didn't pay dividends, because portion of the earnings is paid out in dividends, so the amount of retained earnings on the balance sheet is naturally less than it would be with a non-dividend paying company. So to recap, we have assets and liabilities on the balance sheet. Assets are made up of current assets, non-current assets. Current assets are made up of cash, short-term investments, receivables, inventories, and other current assets. Then we have the total non-current assets, and those are made up of property, plant and equipment, long-term investments, goodwill, intangible assets, and a few more. And we go to the liabilities. We have again the total current liabilities and the total non-current liabilities. Total current liabilities is made up of, among other things, short-term debt, accounts payable, and a few other items. Then the total non-current liabilities are mostly made up of long-term debt and a few other items. And then we have the total stockholder or shareholders equity. That is the difference between the total assets and the total liabilities. And that is what the company is worth on paper. A little portfolio update. In 2020 so far, my portfolio is down almost 30%. Let's take a look below. You can see my holdings. I won't go over them now. You can see that the biggest loser is mega healthcare investors, as healthcare REITs are hit especially hard. If we compare it to the S&P 500 mini future, you can see that my portfolio is down quite a bit more than benchmark. It's saying it's down 39.5%. Looking at the performance since start, you can also see the sharp drop here starting in February, and from 40% almost down to 5.8%. As a former professional poker player, I'm quite used to seeing this kind of swings. So for me personally, I already got a thick skin and I'm used to volatility, because also in poker, volatility can be quite big. And why am I telling you this? Because I think there's quite a lot of comparisons between stock market volatility and poker game volatility. I won't go into much detail now, but what you have to remember is that stock market goes up and goes down. The long-term trend of the stock market, and that's very important, the long-term trend is up. I believe it's a average of 9%. I believe it's an average of 9% that it's going up annually. And one other thing I want to show you that's very important is that the dividends are still coming in. You can see here, 28th February and of March, dividends are still coming in as usual. No dividend cuts yet, and that's because I invest in quality companies. That's not to say that none of these companies will cut their dividend, you never know, but I have faith in those companies enough to keep my shares. And I also have enough faith that they keep paying their dividends and that they will keep raising their dividends. Now my portfolio in the Giro, where I have 3M and SKT, potential factory outlet centers. Especially SKT has been hit quite hard. It's down almost 52%. But again, I'm not worried because their balance sheet is quite strong. Of course, it will be affected by less people coming to their outlet centers. But long term, I think they will survive. They won't cut their dividend because they have a very healthy balance sheet. And then both of my portfolios combined from Bink and Giro, Google Sheets. The dividend information is not pulling correctly at the moment, so just ignore that. You can see cost is 300, dividends so far 704, value is at a little over 7,000, change without dividends is minus 15%, change in dollars is minus 1.2, change with dividends is minus 6.7, the change dollar amount is minus 564. Of course, this doesn't look great. Started investing in 2017 and I have a loss of minus 6.76%. But again, you have to remember this is a long-term game, and over the long term, let's say 20 years, we'll be glad that I stayed invested and that I kept investing in the stock market, because at that time I'll be reaping the rewards of the work I'm doing now. So again, people, focus on the long term and don't think about those short-term fluctuations. If you prefer to have the explanation of the balance sheet in writing as well, I've put a summary of the items we went over today in the description, together with an explanation of what they all mean. In the next video I will be going over the cash flow statement in a similar fashion as I did today, going over the balance sheet, like I did in the previous video going over the income statement. If you want to stay up to date on that, don't forget to subscribe and click the little bell to turn notifications on. If you have friends or family you want to share this video with, please do. And use the share button under this video to do that. More people that can benefit from this information, the better. Of course, don't forget to like and comment on the video. It will really help my channel grow and spread the information out to more people. Till next time, bye bye. Until next time, bye bye.